welcome back to It's the Economy. The banking sector results are mostly done with SBI last Friday and BOB over the weekend. Most of the NBFC biggies are also out. It's time to look at how the Q1 numbers actually panned out. We have with us perhaps the best in the field, Suresh Ganapathy, banking analyst at Macquarie Capital Securities. Good morning, Suresh. Thank you very much for your time. Well, as you look back, are you getting a sense that the first quarter clearly indicated that the best is off for the banking sector with margins and deposits under pressure?
Yeah, that's true, Latha. I mean, we had expected 4Q would have been the peak level of when it comes to both margins and as well as obviously with respect to credit costs at the from the lower end perspective. And we have actually seen both margins actually coming down across the board and also credit costs picking up from the 4Q levels. Part of it has got to do with the seasonality aspect, considering that typically recoveries are down in first quarter, agri NPLs pick up. But nevertheless, still the credit cost is remaining at comfortable level. But one point which I would like to mention is I'm a bit negatively surprised by the extent of margin compression shown by some of the large banks like SBI and BOB. I mean, I definitely had not expected greater than 25 basis point NIM compression that both SBI and BOB had seen, maybe at best 10 to 15 basis points, which actually means as the deposit repricing catches up in subsequent quarters, you can see greater degree of margin compression, contrary to their guidance that they will maintain the margins.
Okay. Yes, it was a 22 basis point NIM decline for Bank of Baroda and 37 for SBI. So what's your take now on these two public sector banks, which usually are, in the list of most marquee brokerages? Are you positive? Would you still go out and buy these two?
So there is still some valuation support, and also know that, Latha, as of now, we really don't see the credit cycle turning, right, for the worse. So as long as the credit cycle continues to remain strong, there will be some pockets of opportunity still available in public sector banks. But I would still prefer, considering the fact that we have seen almost peak level of ROAs and the fact that most of these public sector banks don't carry contingent provision buffer, which is there with the private sector banks. We do believe that the private sector banks can continue to report stronger return metrics for definitely for a much longer period of time compared to the PSUs. So yeah, relative preference still would be privates over PSUs.
Okay. Well, let me get the largest four private sector banks separately and then look at the others. So HDFC, ICICI, Axis and Kotak. Everyone's preference has been ICICI, but it's already done very well. Your thoughts, would you still have it as one of your big buys?
Yes, definitely one of our big buys, because look in this way, Latha, right? I mean, while one can argue that we have reached perhaps the peak level of valuation for ICICI, maybe a little bit more re-rating left. But I think the bigger question here is the fact that can they sustain the current level of earnings momentum and book value compounding? And I don't see any risk to that. They have got sufficient buffers, both when it comes to capital and the provisioning buffer that they have got. So there is no equity dilution risk. There is no major earnings risk. So if earnings can compound at 20%, book value can compound at anywhere between 17-18%, which is in line with the ROE, you are going to make that much return in the name, right? So ICICI remains a good power of compounding. But I mean, I do believe that there are some other stocks like HDFC Bank or IndusInd Bank where there is also a little bit amount of re-rating possible because people have been a bit more negative over the last 12 to 18 months. And that's where I think there would be greater opportunity available.
Okay, so HDFC Bank is your top buy. That's what your report said when the results came in.
Yes.
You're not deterred by the slightly lower deposit growth compared to peers. You think it's one-off and they will be able to march ahead?
So interestingly, Latha, we have done this detailed analysis. We tried to tabulate all the around 30-35 banks in the country, and we looked at their QOQ deposit growth. Actually, it's more or less in line with what HDFC Bank reported. Okay. So I think there is some issue with the system deposit growth number. It looks like some kind of an anomaly. So in fact, HDFC Bank has not lost market share in any way in 1Q, right? I mean, it's more or less in line with what system has reported based on the aggregation of the individual banks' data. So, and And they will obviously drive the business in 2Q, 3Q, and 4Q. So I think they should get back their mojo there, going back to 20% incremental deposit market share by the end of the year. And that's where the opportunity lies in. And more importantly, I do believe that that their target of delivering a 2% ROA even post-merger, it is indeed possible. And that's where the upside comes in when they are able to deliver these numbers even post-merger.
Okay. Yeah, actually, I think maybe much was made of the deposit growth. What I picked up from sources there is that, one or two more bulk deposits and we would have got, the expected number. It is just that there was comfort on LCR and that's why they didn't run after deposits. Whatever, be that as it may, there is a lot of hope that they will do extremely well on the home loan front in particular. But let's come to the next set. IndusInd, Federal, and I don't know which others are there in your coverage. If you can all call them mid-sized banks, though, a couple of them are large, what would you rather bet on them than the big boys?
Look, I think here we have to be a bit more stock specific because we don't cover Federal Bank. But the way we are looking at is that let's assess each and every bank on its own merit. So specifically that bank that we cover, we can talk about it, which is IndusInd Bank. I mean, the point here is that they have a larger fixed rate portfolio. And the fact that we have reached the peak level of rate cycle and perhaps rate cuts beginning next year, next financial year, you would actually see the fact that the fixed rate portfolio holds them in good stead, and therefore they can actually see a little bit positive expansion in margins and also ROA expanding. So I guess selectively where you can actually see further uptick to ROA and consequently further re-rating, such names definitely should be a part of your core portfolio. And therefore, I think after HDFC Bank, we are preferring IndusInd Bank at this point in time, and then ICICI remains our third preferred pick.
Okay, so that's the order. HDFC, IndusInd, and then ICICI. Okay, quickly, one more banking question, and then the NBFCs. Would you worry that there is increasingly higher reports of unsecured credit not doing too well, and there are limits to retail, isn't it?
Yeah, no, that's right, Latha. There have been some, constant emails and reports we have been writing that, there is a problem in the personal loan segment, but largely it is currently emanating from the smaller ticket size personal loans and more in the lower markets, right? Tier 3, Tier 4 centers. Let's put it that way, Tier 2, Tier 3, Tier 4. So I guess the kind of customers that banks are catering, I am okay with that. So what happens, Latha, here is the order of stress would be first in fintechs, then you go to NBFCs, and then you go to banks. As of now, we are still quite some time away for the stress to manifest in terms of banks book, because first it has to get manifested in the books of NBFCs, right? So to that extent, we are still very comfortable with respect to risk from unsecured loans for a banking system perspective.
Okay. All right. Now to come to the NBFCs, Chola's was very strong. Bajaj Finance was stronger than expected. I thought that's what your note said. What is your ascending order of preferences there?
Look, I think we are still going with quality here. We do like Chola, and at the same time, at the other spectrum, we do like Shriram because of the fact that valuations are cheap. Bajaj is a good company, but at expensive valuations. Therefore, we have an underperformed rating. But one point which I would like to drive across, Latha, very clearly, where we are very surprised is this continued strong growth in the overall ecosystem, loan growth, right? So not only banks, but these NBFCs have also shown stupendous growth this quarter across the board. Even a company like Shriram, which typically grows slower than everybody else in the system, still delivered an 18% growth, right? So that clearly shows the underlying growth momentum is very strong. And though there is margin compression that again was very evident in all the NBFC numbers, and this margin compression is only going to get accelerated, I think growth can offset that. And that's where I think some of these NBFCs have done very well, because growth expectations have been reset higher. Everybody knew margins are going to compress, but nobody expected growth to remain at these very strong levels. And all indications are that growth is here to stay for the time being.
Okay. Where do you stand on Paytm? Because just news coming in, fresh news that Vijay Shekhar Sharma is going to take over the 10.5% stake of Antfin. even if the economic interest remains with them or something like that. But
Which
the
is
point
surprising.
is,
If the economic interest is there, Latha, how does it change? So I don't know. I will have to get some clarity from the management.
voting rights are with Paytm. But be
Okay.
that as it may, your call on Paytm.
No, look, I think the call on Paytm also again now interestingly coincides with the call on the credit cycle, right?
Okay.
So if we have been arguing, we upgraded the name in the past, I think 6 months ago. What we argued was that they have been surprising us very positively on the financial services business, which is the distribution of loan products, and that's where the cycle remains very strong. Their credit loss experiences on buy now pay later products have been very comfortable. So I guess if this credit cycle continues for a longish period of time, you will continue to see these strong growth numbers. So if you look at the loan distribution business, it's been growing at 150% year on year. The day that starts slowing down materially, that's the time where Paytm, there would be an issue with respect to their ability to deliver that profitability track record that we are expecting at this point in time. So yeah, I mean, as long as that continues, the stock should be okay relatively.
Okay, and now for the difficult part for NBFCs in particular, the rise of Geo Financial. We don't know what shape it will take, but would you hesitate to go whole hog on NBFCs merely to see how this one shapes up?
So look, it's some time away, Latha, before things, they are of course in the process of building up the management. They have a CEO, COO, CFO, everybody in place. But the point here is the first step is on August 28th. I think that's the RIL AGM, right? So we would want to know what exactly are their specific AUM plans. So let's put it this way, that the first trigger for the NBFC stocks to get affected, even though the actual implementation would be some time away, would be if at all they'll end up giving, say, hypothetically, a particular AUM size that they're targeting. Let's again assume hypothetically that they want to build ₹1 trillion of AUM in the next 5, 6, 7 years. That's half of what Bajaj Finance is today, right? So that's a very significant goal and an outlook. And if that indeed happens, then there is going to be a corresponding effect on the NBFCs. But as I said, for the business to be set up on the ground and try to be a bit more disruptive for the NBFC model, we are quite some time away. Even within that, Latha, just an extra 30 seconds, they won't disrupt the secured lending market. So a Chola or a Shriram for the time being is fine, because you is not going to enter into commercial vehicle finance and other vehicle financing, right? They'll start off with consumer loan lending, personal loan lending, and digital finance, where there is a greater scope to disrupt, say, some extent a Paytm business model, or for that matter, a PAF model, rather than a Shriram Transport or a Chola model at this point in time.
Fair point. Thank you very much. We have tried to cover as much ground, Suresh. Key takeaways: credit cycle very strong. Geo Financial, we'll still wait to see how it shapes up. Banks, yes, the best is passed at Q4, and the order is HDFC, IndusInd, and ICICI. Thank you very much for that. It's time to take a break and go back to Chartbusters.